You've probably heard with infinite banking that you're borrowing from yourself, but is that really the case? And more importantly, does that even matter?
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today, guys, we're going to be talking to you guys about the truth about policy loans. Guys, this is one of the most misunderstood features that you'll find in infinite banking. And additionally, this is probably one of the biggest missteps that people make, or confusion that people have when they first get introduced to the infinite banking strategy. And so I'm excited to share this with you guys today and clear up any confusion. One of the main reasons that we want to kind of take this today is because as people approach this and they come across this idea, the confusion can cause a lot of hesitation for people as they get started with infinite banking. And usually, Anthony, I'd love to get your input after this, but usually I see it kind of fall in one of two categories. Right? If people get started, they get confused on exactly how policy loans work. They usually do one of two things. The first one is they don't take any policy loans. And so they have cash value just sitting there, and they think that a loan is going to be detrimental to the infinite banking strategy, or they do the exact opposite. And what they do is they take loans really for no reason, just to be carrying a loan. So that's what we're going to be talking to you guys about today. We're going to be giving you the truth on policy loans. Anthony, what are your thoughts?
Well, I'm glad we're doing this subject because there is a lot of confusion, particularly about policy loans. Cameron, how many times have somebody told you that they thought in order for their policy to grow that they had to take loans?
Many times, and if you don't mind me sharing quickly, is I had a guy call me and asked me to take a look at his policy, and he sent it over and it had a max loan on it. And he'd had that on there for like the first 2 years of his policy. And I asked him what the loan was for, and he said nothing. He said he had the loan sitting in cash at his bank account, right? And I'm like, well, why did you do that? And he said that the practitioner told him that the loans were magic, and that's how his policy was going to grow.
I will tell you, I hope you're using the term practitioner loosely, that he's not a certified practitioner, because there is a certification from the Nelson Nash Institute to certify people as IBC practitioners. And hope those people should know better than to say it's magic. But I see it all the time. Or one of my favorites is you see a guy online on how they took a policy loan and bought their Ferrari, and now their policy is much larger because of that loan. That's not why the policy is much larger. It's much larger because the policy is going to get larger each year. But I know we're going to get into it, but I do enjoy setting the record straight. And so I'm glad that we are doing it here today.
So am I. Anthony, I'm going to kick this over to you. Do you mind sharing with our listeners what they need to know about policy loans?
One of the important things that people need to understand, you're not borrowing from yourself. We're not borrowing from your specific policy, right? We're using your policy as collateral, and we're borrowing from the investment arm of the insurance company. Now, that is key to infinite banking, and the reason being is because your policy is still there. Your policy is still growing and compounding, whether you have a policy loan or not. So that loan, all it does is a loan repayment just replenishes the policy. It's not making it larger, right? And because of that, because we're borrowing against your policy, not from your policy, that's why the terms on policy loans are the best loan terms available. That's why they don't need to report it on your credit. why they're not going to ask you what it's for or how you're going to pay it back. All they're going to ask for, how much do you want? Where do we send the money? And the reason being, the insurance company is going to get paid, right? If you don't pay that loan back, they're literally wait until you die and take it off the death benefit, right? So, but the key thing here is by doing so, your policy is continuing to grow. So those people that are out there, I've got plenty of them, they get scared to take that loan. And I got one in particular, she hadn't taken a loan in 7 years, and it just now clicked. And now she's like, wait a minute. So if I take this loan and buy an asset, then use a cash flow from that asset to repay the loan, my policy is going to be in the same spot. And now I have that asset, it kind of clicks, right? But that's where the power of infinite banking is that we put the money in a policy and it continues to grow whether you use it or not. Cam, I've kind of talked a little bit more, maybe more than I probably should have. I'm looking at our outline, but well, you want to explain exactly more, like give an example of how this works?
Yeah, I'd be happy to. And again, it might be a little bit of overlap there, but what I want to talk about again is the how this is actually going to work. And so I'm going to walk you through what we broke down to kind of the 5-step process. Let's say that we have either created $50,000 in cash value right away, or we've built up to $50,000 of cash value in a policy. The next step that you're going to do on how a policy loan works is you're going to call up the insurance company and you're going to request a loan. The way that you do that is you actually call up the insurance company, you speak to the rep, and you're going to use some very specific wording. And you're going to say, I'd like to take a loan against my cash value. What the rep on the other end of that line is going to do is she's actually going to pull up your account. She's going to see how much cash value you have. And essentially what the insurance company is doing is extending you a line of credit that is equal to the cash value that you've created in your policy. When you ask them for a loan against your cash value, let's say that it's $30,000. The next step, the first thing that the insurance company does after that is they actually come in and they're going to put a lien against the cash value of your policy. And the next thing that they do is they're going to send you $30,000, like Anthony mentioned, not from your policy, but they're going to send it to you from the general fund of the insurance company. Now, at this point, they have a lien on your cash value. You receive the $30,000, and now it's up to you to set up some sort of repayment schedule back to the insurance company. One of the best things about infinite banking is that you're going to dictate any sort of loan repayment back to the insurance company. The only thing the insurance company does after you request a loan is they're going to give you a statement one time annually. It's going to go out 30 days before your policy anniversary. And essentially what it's going to be is it's going to be a statement or an overview of where your policy is currently at. So they're going to give you an outline of any premiums that are coming due, but they're also going to give you a snapshot of your policy. And they're going to say, here's your gross cash value. Here's any loans outstanding. Here's your loan interest, and here's your net cash value if you have any that's available for you. So that's the 5-step process that's going to happen. There's a couple of things that I want to highlight here in this.
Imagine if you could grow your wealth, access your money anytime tax-free, and never break the compound interest curve while you use your own money. Well, that's exactly what the infinite banking concept does.
And we help investors just like you implement this strategy, and we'd love to show you how. Schedule a free call with us and start taking control of your financial future today.
The link to schedule that will be in the show notes.
And we've been throwing around a couple words, and it's going to be lien versus loan. I want to make sure that our audience and Anthony understands the difference between these two. So a loan is the money that somebody is going to borrow, right? It's the actual dollars that are exchanging. But a lien is the legal claim to the asset. So I'll give you guys an analogy, an everyday analogy that everybody understands. But for some reason, when it comes to life insurance, everybody loses their mind and doesn't quite make sense. When you go down and you finance a vehicle, you're asking the bank to finance that vehicle. You go out and you purchase it. So you are now the owner. You're the one driving the car around, but the lender has a legal claim or a lien against the title. And so that is the difference between a loan versus a lien. Does that make sense, Faso?
Yeah. Mm-hmm.
Perfect. All right. So a lien is actually really important in this scenario is because it's actually beneficial to both parties. So in our scenario, we've got a lien of $30,000 against the cash value of our policy. And this is going to be beneficial to both me and the insurance company. One of the reasons, the number one reason, in my opinion, that it is beneficial for me is because I am going to be earning uninterrupted compound interest. Because the insurance company does not take the money out of my policy, the cash value is sitting in there, continuing to grow and increase. And not only does it increase this year, but it increases and compounds every single year moving forward. The second reason that liens are beneficial is because we stay in control. When we have a lien against our policy, we actually have increased financial flexibility, is because when I ask for a lien, they're going to send me the money. I can go do anything that I want with those dollars. But again, the money's still in my policy, continuing to grow, and I have control when and whether I pay that lien back. The third reason that I would highlight here as far as why liens are beneficial, not from the client's point of view or the policy owner's point of view, but from the insurance company, is because there's a guaranteed repayment for the insurance company, which Anthony mentioned a minute ago. But there's two ways that really three ways that an insurance company can get paid back. Two of them are guaranteed. One is if I take a policy loan against my cash value, I can set up some sort of repayment schedule during my lifetime. If I go through and I make that schedule and I pay the thing off, great. But secondarily is in my lifetime, if I choose not to pay that loan off, I can call up the insurance company and say, hey, I'd like to take this loan off the books. And what they're going to do is they're going to cancel that loan. They're going to close that loan out. I've already got my money, right? Because I had it initially in the form of the loan. And they're going to take the cash value of my policy and they're going to move it over to their books. So they don't lose anything either. So it's a win-win for me. It's a win for the insurance company. The other scenario that can happen is if I defer that loan or carry that lien on my policy all the way until maturity or death, before I pass or when I pass, there's going to be a death benefit that's going to kick in. And before they pay that, they're going to reconcile any sort of loans that are outstanding on my policy before they pay the beneficiaries. So what I would mention here is that next time clients or next time you guys hear the word lien, is I want you to think leverage. Liens are a feature of the policy. They're not a flaw. Does that make sense?
Mm-hmm.
Awesome. All right. So let's jump into the other thing that I would highlight here as we're talking about loans and how it works is we do need to speak about loan interest. So when I take a loan against the policy, there is a loan interest rate. That loan interest rate can vary anywhere from maybe 5. I've seen it as low as 4, but I've seen it as high as 7. So the main carrier that we're using right now is charging 5.3% interest on our policy loans. And again, a lot of people will look at this as a negative, but we view it as a positive. And let me tell you why. It's because the loan interest is the cost of controlling your capital. Remember, when you're operating and you're investing or you're buying large purchases, you only have 2 options. If we've created cash value, the first option is we can surrender, which is going to be us paying no interest, but we're also not going to earn any interest. The second option is the one that we are recommending to clients, which is where we're going to utilize the loan provisions on the policy. We're going to borrow against our cash value. And when we do that, we are going to pay an interest to the insurance company. But again, we also earn interest with that continued compounding growth over time. So that is a strategic use of leverage. One of the best analogies that I can give is a home equity line of credit.
Mm-hmm.
We've used this analogy before, but it is one of my favorite. Let's say that somebody has $300,000 in equity in their house. No one in their right mind would go and sell their house just to tap into the equity that they have. But yet people think that that is the best option, again, when it comes to cash value. The best option, and people do this all the time, is if we've got 300,000 of equity, is we're going to go get a line of credit against that equity in the house. And so by doing that, right, we're able to access the funds, but we also have our house still being able to be used and still appreciating and growing over time. So again, the analogy that I would be using when we look at loans versus cash value and IBC is that the house is going to be the cash value and the line of credit is going to be the policy loan. Faso, is that clear? Is that helpful?
It is helpful. And Cam, actually, I really like the way that you explained it. Very common, similar to a HELOC. I like how you added, you're not going to sell your home to tap into equity, right? And the reason being because your home's going up in value and you want to get a part of that. So instead of selling the home, the asset to get the equity, you can leverage against it with the HELOC. And that way the asset's still growing. You still have control over everything. And it's the same thing on the policy, right? If we're going to buy an asset, if we use cash, we're just selling the asset to buy another asset. But with infinite banking, we're not selling the asset. We're just leveraging against it. I like how you added that. Cam, with this interest, is there a way we can write that off?
There is. With proper documentation, we can absolutely write this off. I appreciate you teeing me up, but you're the accountant. I'll kick it over to you, man. Tell the listeners the opportunities that we have with that interest.
The key thing is if you use a policy loan to create taxable income. Now, that's not buying a personal car. That's not a down payment on your personal property or paying for vacations or paying off personal debt, right? That's not creating taxable income. But you loaning it to your business or using it as a down payment on a rental property, or if you lend that money, say as a hard money lender and you're generating taxable income or interest, we can deduct the interest we pay against the income we earn. And we always, and a lot of times people focus on those two pieces, but you reminded them your money in your policy is still growing, still compounding. The cool thing is that is compounding on a tax-free basis. And that is compounding interest. And these loans are simple interest. So meaning the balances goes down every time you make a payment, and your policy is the opposite. It's increasing every time you make a deposit. And Cameron, I also like how you reiterated, we take a policy loan to do X, and X turns out to be a terrible investment. We lose all the money. We can always call up the insurance company and change that loan to a withdrawal, because I think that's one of the things people get caught up on. So you did a really good job on just explaining that. One follow-up question, Cameron, what happens if you're in a bind and we can't pay the interest? If we do this on my HELOC, they're going to come take my house and ruin my credit. What are they going to do for the same thing on a policy loan?
The insurance company at the end of the year, they're going to send you that statement. It's going to say, here's your interest that is due for this 12-month period. If you do nothing, you don't pay anything back, they're just going to carry it over to the next year. There's no recourse on policy loans. To add to that is I was going to add the comment or the sentiment I shared in a few podcasts ago was we always talk about a slow start, but we often miss out on the fast finish. And I think that analogy plays well with policy loans, is that people, when we take a policy loan, is they get so focused on the interest that the insurance company is going to be charging, is they completely forget that we still have growth inside the policy. And I think that this happens often, especially early on in a policy, because when we do start a policy, there is that negative or that slow start early on. And so as you guys are out there thinking and you're thinking about policy loans, always remember that not only do we have a policy loan interest, but we've also got policy growth that's happening inside of the policy. And especially on a policy that's 3-4 years old, you'll be able to identify that pretty easily. Anthony,
Perfect. Well,
now we've given these guys a pretty good overview of policy loans, some of the practical steps that happen when we look at it. What should they be doing next?
well, what I think we need to reframe the fear. Right? Your policy is more than just simply a savings account. This is like a financial engine. And taking a policy loan does not hinder the growth of your policy. If anything, it activates the power. What I would encourage someone to do is, for one, one thing Nelson talks about is everyone should be in two businesses, the one that they generate their income from, and then the banking business. And we got to put on our banking hat. And Cameron, let me ask you this. Is a loan, is it an asset or a liability?
For who?
Great question. Why don't you expect? That's what we need to think. For the whoever's borrowing the money, it's a liability. But to the institution that's loaning it, it's an asset. So to me, it helps when you start thinking like a banker, and banks make money by taking loans, right? And that's because they're using the loan. Well, they make money on a loan when it gets paid back with interest. And that's what we need to be doing, is taking a loan and paying it back with interest, and just realize, put our banker hat on. This loan might be a liability to you personally, but it's an asset. It's an asset to the bank. And so what I would say is an action step. Don't be afraid to take a loan. And I get it, if you're on there, I tell you, the first time doing anything is always the scariest. You're not kind of sure how it's all going to work out. And I tell you, I was talking with a client the other day, and his wife, he wants to do another policy, and the wife doesn't fully understand because she hasn't been through education process. And she was questioning, could I really get my money back 45 days after setting up the policy? And I know there's a lot of people out there that have that policy loan, and then they're just scared to take that next step. What I encourage you to do, take a loan. Take a loan, for maybe $1,000 or $5,000. Just see the process. How long does it take? Right? You can see how easy the process is. And even, Cameron, you'd mentioned when you're taking a loan, you need to use a certain verbiage, talk to the insurance company. When you're working with a certified IBC practitioner, at least with us, part of our service is helping you with that process. You don't need to make the phone call. We will prepare the paperwork and send it to you via DocuSign, and it'll be direct deposit in your account. So try out this loan, see how quickly it gets it, and then start paying it back. And then you need to realize your policy is going to grow whether you use it or not. So if you don't use it, you're going to lose that opportunity. And I would tell you, there's been a lot of opportunities I've passed out on, in part because I had some fear about rental real estate. But, part of it was I wasn't educated enough. All I heard were the horror stories and the bad things that happened. I didn't do my own research. So that's what I would encourage you. If you're still on that fence, do some research. Don't just take don't take our word for it, but really to get in the game, I think really the best next step would be is to get on a call with us. We have a free discovery call, 15 to 30 minutes where you're actually going to talk to Cameron or I, where answer the questions you have and kind of see is if infinite banking is a good fit for you. If it's not, then we're telling you we shouldn't move forward. But if it is, we can give you some solid next steps. Because really what's going to happen is if you want to live that life that you've dreamt of living, it's going to take action. And that action can easily start with a quick phone call. So the link for that will be in the show notes. Cam, what else wisdom you want to drop?
No, hopefully we conveyed to these guys that policy loans aren't scary, right? And that they are actually one of the foundations of the infinite banking strategy. And so if you guys do have questions, Anthony said, call us. The loan provisions, one of my favorite things about infinite banking is that we're using contracts, whole life contracts. The loan provisions are right in the policy. And so if we have any questions, we can pull up the policy, go right to it, read it, and make sure we understand it. And now we've got that working for us, which allows us to have more control over our personal finances. So again, hopefully we cleared up some confusion for you guys. Hope you enjoyed this episode.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.